So let's get started with the first part of presenting our work, our research work on merchants, led by Michelle Hassan, an associate at BFA. Michelle?
Yeah, thank you, Eugene. So micro and small enterprises are the core drivers of growth and employment, especially in emerging markets. And we've seen that these enterprises actually account for 80% of Africans' employment, with small shops, or what we call here in Kenya, dukas, forming actually an important part of MSME sector in Africa. Here in Kenya, it's actually estimated 95% of population frequent dukas. And we, as BFA, we wanted to find out more about this segment. So in the recent study we've done under FIBR, we found shops fall into actually three types of categories. So we have a business type of people who, these are shops owned by people who already have experience in operating businesses. They have longer term visions of their shops and ensure that their shops are fully stocked and upon customer request and demand. We have this comfort zone level that they just have enough stock to go through the day, the business generating enough income and operating successfully, but however, they're unable to grow. And also we have the last one is called the empty shelves, which is mostly, they have very little stock. So what we wanted to find out under FIBR was, how can we make these businesses under comfort zone to be able to move into like business people and more successful. So in May this year, next slide please, Jane. So in May this year, we talked to some of the merchants and realized that these small shops actually follow a pattern or a life cycle. So they go through these predictable stages that FSPs should learn to recognize, and in terms of offering services, particularly when it comes to digitization. So if I am a shopkeeper, I want to say, okay, I want to start a shop. What should I do? So there's the first phase, which is called the initial investment. They started with these shops with an investment probably $200 to $350. And these investments are usually from a gift from someone in the family, husbands or siblings, or if they were formerly employed, savings from that. And how they start off is this business is very kind of small and tiny shop or an outside stall, which here in Kenya we call it kibanda. These initial investments lasts probably like a year or less, and the shop features very limited stock. So they usually start with goods like milk and bread, and then as they generate more income, keep increasing variety of products. But also what we've seen during this phase is the merchants have started to build relationships both with the customers and the suppliers. After the initial phase, the merchant moves into the expansion phase, which it can happen between either some years or some months. And by this time, actually, the merchant has been able to build relationships with customers and suppliers and feels the demand for good is increasing. But what we've seen during this phase was the merchants use informal sources of credit. So they go back to family and friends and chama or savings groups to come support this expansion phase. And what we've seen is during this expansion phase is very critical to the long-term viability of the partners. If the business expands successfully, then it goes into this stability phase. However, if the business hits a roadblock, it may not recover. So either growing too fast, taking on too many expenses, or a personal shock like health emergency or death in the family can result in the businesses collapsing during this stage and the shopkeeper starts all over again. However, if they're able to pass through the expansion phase, then the merchant goes into the stability phase. And this is where the merchant kind of maintains the profitability of the shop while making small improvements. This phase usually lasts between 3 to 5 years. And in our study, we saw that during this phase that the merchant's biggest challenge is cash flow. And they end up using a lot of either digital loans like M-Shwari and family and friends to help with this cash flow. So what we saw was some business were comfortable in this phase and might not want to do further expansion and can just be there for a long time. And at this also category or this phase, they are able to want to access credit of like around $100 to $200 to help them with this cash flow challenge. However, those guys who want to expand, this usually occurs in the last phase, and which we call the more expansion phase. And there we saw merchants expanding to other businesses like M-Pesa business, or becoming a big shop like a wholesaler or a supermarket, or in some instances, opening other retail shops in a different locality. And because this part actually requires a long-term expense and a higher amount, like $1,000 to $2,000, this is where the point where merchants access microfinance institutions or formal financial services to help out with that, because it's too large of a swing. Okay. I think next slide. So in terms of what did we see in terms of sources of loan? So we saw like kind of 5 different types of people who are helping merchants. So from family and friends, suppliers, digital loans, and savings groups that help a lot, like in buying stocks and assisting with management or assisting with shocks. But they were only able to go to formal financial services primarily for the final expansion of the business. Next slide, Jane. So a kind of key question we had as FIBR is, what can FSP play a bigger role? So initially in the first phase, we don't see FSP having like the initial investment playing a bigger role. But in the expansion phase, we see FSP playing either a role in terms of offering insurance product to help with the risk aversion or other shocks they have, loan to first do the initial expansion, and in some cases, support with some business skills. In the stability phase, we see FSP playing a bigger role in terms of either giving them access for loans for inventory or stock, or sometimes short-term cash flow credit. And this could either be digital or non-digital loans. And in some cases, FSP will actually offer credit to supplier who can then on-lend to these merchants. And probably in the expansion, the second expansion phase, what we've seen FSPs kind of could be able to do, one is offer digitization tools for the merchants to be able to create more data, but also offer more credit for that further expansion. We know from this, like FSPs might be excited, like, oh yeah, can we be able to start digitizing from the beginning? But we saw from all the merchants it is only in the second expansion phase that they were willing to start digitizing their records, because now they have more employees, they want to keep better records because they want to access loans from a formal institution. So it's not realistic to actually think about digitizing records in the early stages, as they also have other competing needs, like surviving the first few years of the shop cycle. Okay, thank you.
Thank you, Michelle. Let's pass it on then to Javi, who will share the research from our pilot with SocoWatch.
Can I then move the slides?
Sure.
Yeah.
There you go.
Yes, thank you. Yeah, so for the last year, FIBR has been working with a Kenyan startup. It's called SocoWatch. They are an e-commerce platform that supplies fast-moving consumer goods to urban retailers in Kenya and Tanzania. Yeah, consumer goods like Unilever, Procter & Gamble, and some local wholesalers. So when the merchant is running out of stock, they can place an order through SocoWatch platform, and the closer delivery agents will deliver the goods within the next 2 hours. So with them, first we did a financial study of how these small businesses access to credit today to understand different sources of access to working capital. And then we designed and piloted a credit solution using smartphones that we allow us to learn how these suppliers can play a role on the lending model. There we go. Sorry. Perfect. So what we saw is that these merchants are very active borrowers. So, and the main reason why they access to credit is to buy stock, right? So 85% among the users that we interview and has borrowed for the business, and 50% of them borrows on a regular basis. The financial instruments that these small merchants use today, as Michelle has mentioned, are informal savings groups, like the chamas in the context of Kenya, but also family and friends, and digital loans. And in particular, M-Swari, which is provided in Kenya by CBA and Safaricom, as well as suppliers. However, these source of access to working capital are easy to do, but are not convenient because you cannot be asking your friends every day if you need to buy stock and for some reason that day you didn't have cash. We also saw, let me move to the next. Yeah, so, and interestingly, none of the users that we talked to has neither borrowed from a bank, a microfinance, MSME specific lenders, or even the digital lenders such as Tala or Branch. And after that research, we concluded that what the merchants need is smaller loans, but recurrent access to working capital to purchase inventory. There we go. And within this ecosystem, we have the suppliers that are uniquely placed to offer lines of credit to the merchants. However, there is a stiff competition among suppliers. So in order to get the share of the shop and in order to compete, local suppliers are also starting offering lines of credit, as well as cheaper prices, delivery, and a very close customer service. During the research, we also talked to 8 different financial institutions in Kenya, including banks, microfinance, and digital lenders. Some of them are more eager to reach down the market, and in fact, some of them already offer some loan facility to the micro retailers, but they don't pursue the micro retailers as a segment. And the main reasons that is there is not enough report data about the merchants. So all the transactions around the shop are still in cash and outside the banking system, so they are invisible for the banks. And they also felt that it was important to have an on-the-ground partner or an agent network to manage that customer relationship with the merchant. Someone who can follow up on repayments if it's necessary, but also who knows where the shops are located and even can also do some deposit taking, for example. After an iterative design process, we came up with an app-based credit solution developed by SocoWatch. It's based on 4 different tiers, like ladders, where the limits are set on the previous transactions with SocoWatch. And this limit can increase if you show like a good payment behaviors, but can decrease otherwise. The merchant has to pay a small fee to the agent upon delivery on top of the purchase, and the repayment period is 7 days. So for example, you can purchase on credit on Friday and then pay back the next Monday once you go over the weekend. The numbers so far for the pilot, it has been running for the last 6 months. We wanted to keep this pilot in a very small control group. So among 25 eligible merchants, we have seen over 100 loans so far, worth of 6,000 USD in products. And out of these 25 eligible merchants, 50% of them has used the loan already. And we got 0 non-paying loans, although there was 2 merchants that saw some delinquent behaviors with a few days on delays. If you see the chart, the purchase on credit are clustered around the $50 and $100. And also the fee help us to utilize the limit of the credit. And it also proved to us that charging this small fee, it was not a barrier for usage, despite some protests from the merchants at the beginning. We have also observed 3 different loan behaviors in terms of usage. In one side, we have the weekly borrowers, the ones that purchase every week. For example, every Tuesday, they pay back the previous loan and then they purchase again. This represents 25% of this sample. Then we have the occasional borrowers, and those customers that still prefer cash, and they will use cash. But in a particular day, because of some cash shortage, they use the credit as a backup, and they also represent 25% of the sample. And then in the other side, we have the cash users that represent half of them, and they always use cash, even if they can purchase on credit. Some of the main reasons for using cash is, first, they are afraid of credit, probably because of bad past experience with managing credit, but also because they just need a few items. So if you just need, let's say, $2, there might not be a reason to pay on credit because you might have the cash available. Yeah. When it comes to smartphones adoptions, I think we need to be ready to really work with a customer base that might have smartphones, and in fact, more than half already have a smartphone, but are not ready. And the reasons are the smartphones are faulty, phones are older or even damaged, and the low quality of the hardware. There is also limited connectivity, so still data bundles are out of reach for some of these users because it becomes expensive to be connected daily. And there is also a lack of digital knowledge in general. The process of just going to Play Store, download an app, and sign up into an app, it could become a very painful process. The main 2 high-level key takeaways from the pilot is that suppliers hold the value proposition with the merchants. In particular, that person that goes to the shop and deliver is the key to adopt the service. The other is there is still an opportunity for financial service providers to partner with suppliers. However, this partnership has to be compelling. First, it has to make sense for the merchant to buy goods on credit. And then it has to add value to the supplier to partner with a financial institution. So we need a win-win scenario. Some of the actionable insights for structuring these partnerships is the first: digital is not enough. Some of these users, they will always require that face-to-face explanation of the credit and how it works, and how do you have to pay back, how do you start using it, and what happens if you, for example, you delay. They will expect that even if it's within the app, and the app explains how it works, they might expect that coming from the agent. Also, we need to have the right processes in place, in particular when it comes to reconciliations at the end of the day, to be able to know how much is from the cash made the sales made on cash, but also like the repayments plus the fees, and also be able to follow up on delinquent customers. Then providers need to use data. They could leverage these suppliers' digital transactions to design the product, but they also need the tools to monitor the performance. So providers need to be able to keep track of the loan portfolio performance. And that's from the SocoWatch pilot. Jane?
Jane, you're on mute.
Yes, I thought I had unmuted myself. Thank you. So thank you, Javi and Michelle, for sharing the research work. From here, we wanted to use it as a basis for discussion. We have here in the room Javier Fast, the Digital Finance Frontiers lead at CGAP, and Ignacio Maz, ED and co-founder of Digital Frontiers Institute. So let's jump into a discussion between the five of us. And let's start with a couple of I'll frame the conversation around agree and disagree statements and use it as a launching point for our discussion. So this goes to you, Javier and Ignacio. What are the main challenges you see for merchants to access finance for inventory?
Okay, I'll start. I think the main problem the merchants have is that they're invisible as far as the formal financial system is concerned. And visibility really is solved by digitization. So there's data that can be used to quantify them and to pass them through normal banking procedures. So digitization really is a prerequisite for that to happen.
Well, so I agree with that. What I would add is that even when there's enough data that can show the cash flows of a merchant, and a financial institution can use that data to offer and assess risk and offer loans, the operationalizing a line of business for established banks that addresses the small merchant segment has a lot of hurdles. Just because the way these it's a different kind of product than what traditional banks offer, and the kind of force on the ground that you require, the kind of risk assessment. There's a lot of things that make those products different. So I would argue that in addition to the data, financial institutions need to make an extra effort to build a line of business that is different in many ways than what traditional services they operate.
If I can comment on the availability of data, part of the problem is, there is some digitized data on the stores, but it's all very partial and not adding up. Like, for example, there might be some digitized transactions because they were paid with mobile money. Okay, that's 5% of their turnover. Or it may be that Coca-Cola or Pepsi-Cola or some big distributor like that has some digitized data, but again, they only supply 10% of their products. And these are not additive, so banks don't really get to see how all this adds up into a consistent picture of the store.
Great. On that point, agree or disagree? I realize I jumped over my first one, so I'm sorry if I confused you. Agree or disagree? FSPs want the data about merchants, but they don't want to lend.
I do disagree. I agree on the first part. I disagree on the second part. And the second part is a point of principle that basically the data doesn't add up to enough for them to really want to make the effort that Javier was saying of designing a program for them with outreach, with product, and so on. So I think what is clear is that financial institutions or banks are not going to take the lead in digitizing business, helping digitize businesses, so that then they can offer financial products. So they're going to be more waiting in the sidelines for digitization to happen some other channel, and maybe at that point they'll step in.
Well, I think there's an additional hurdle that has to do with sizing the segment. A lot of times, financial institutions are not necessarily aware of what business is here. The lending opportunity is probably obvious and evident, but not sure how it compares to other opportunities they might have or that might be weighing this against. So how to make the case that this should be a priority.
Yeah.
And if I can jump in on that from the merchant perspective, the merchant needs to find out also what's the value of me giving you as a financial service provider the data. So we in a quagmire where the FSP wants data, but the merchant's like, okay, I need to make more sense for you to give me data. I'm not going to be doing bookkeeping in my first couple of months. I need to have my business survive. So at what point do you actually start collecting that data?
Yeah, I think that's right. I mean, credit will come at the end of the process. It's not the carrot at the beginning. So the big question is, so who is going to, or what is the reason why merchants are going to want to digitize? Because just for that potential loan, they'll come down the road, but they're not going to do that.
Okay, anything to add there, Javi? Javi, PFA Javi? Yeah.
I do agree with all of that. Yeah, I think data is part of the lending decision, but it's not the only thing. So there is also operations involved. There is other aspects that we need to consider aside from the data. And we have seen there is willingness to lend. And in fact, some of the financial institutions already lend to the small businesses, in particular in the Kenyan context. Yeah, but as Ignacio said, is very partial. The data is tied to either a supplier or to either a bank.
So question to you, Javier, what about the opportunities then for MSME financing by partnering? What are some of the opportunities you see?
Well, my sense is that, well, as Javier was saying, there's already banks that are involved in lending to the MSME sector, but then how low they go, how small do they go? So probably whatever is happening is great, but I guess the case we're making is that there should be more, and there should be more going to the micro and smaller shops and enterprises. I think in addition to that kind of lending, there's a lot of lending that happens within the specific value chains. The suppliers financing either explicitly or not the sale of their products. And you know, I could argue, or we could argue, that it would make a lot more sense to have partnerships between suppliers and financial service providers that enable the external financial service providers to carry the lending on their balance sheet, so that it is more efficiently managed, and it could be done at a lower cost because the cost of capital would be lower, arguably, by a financial institution. So I think there's a case to make about partnerships that enable off-balance sheet financing for suppliers, so that there's third parties, banks or financial institutions that do the lending, and suppliers do the sales. That has a lot of things. I mean, that raises a lot of questions around moral hazard and how do you make the partnership work. But I think there's those are things that might be solvable.
Javier, Michelle, do you agree with that, and based on what you were seeing and maybe some of the reactions from suppliers themselves?
Yeah, I think I agree. I think it's going to be difficult for financial service provider to go to each and every merchant to collect data, but the supplier is already on the ground having that relationship with the merchant. So how do you leverage that relationship that the supplier has with the merchant, and they're already having data, at least some data for the merchant. So the partnership between FSP and the supplier makes much more sense.
Yeah, I agree on that.
What about, so we kind of already looking at the role of suppliers, but we've heard, you know, some players wanting to finance the credit themselves. What is your thought on that? I'll take that from anyone on the panel.
Sorry, say it again, Jane.
What is your thought on suppliers we've seen wanting to finance the credit themselves?
I mean, I can speak on behalf of the pilots. So, for example, SocoWatch, they already get some kind of credit facility from manufacturers, like, yeah. And for them, it's easy to extend that into their retailers. And also, in the other side, we haven't really seen like a real value proposition from the financial institutions to bring on the table for SocoWatch to say, yeah, I want to do this with you because it makes sense. There is no like, that's what I've always like saying, that we need a compelling partnership between the financial institution and the suppliers, because otherwise the supplier is going to do themselves, and it's going to be cheaper for both for the merchant and for the supplier.
Okay.
Yeah, I think at the end of the day, who underwrites the risk is less of an issue. The issue is more what are the role of the suppliers in facilitating the credit, and of course is the referral. There's the passing on of regular information on the goods going through the store, but also potentially they can also implement some sticks, right? In terms of the how much they're willing to leave with the store, or how often they want to visit, based on how they repay. So they also have a role to play, not just in terms of passing on information, but helping in the enforcement.
Yeah, I one thing I would add is as the team was explaining earlier, there's different kinds of shops at different stages, and some shops, if they are borrowing the same amount every week to finance the purchase of supplies that then they sell, it's a very predictable flow that the supplier has full visibility on, and the cost of lending might be very low, the risk is low, and you actually don't need capital because you finance through receivables. So that might make a lot of sense to have on the balance sheet of the supplier. On the other hand, if those merchants that are looking to expand, that need a lot more capital than what they traditionally sell, that does require capital. That has a different way of assessing risk, and maybe that's something that a financial institution might be better involved in. I think maybe we need to think in those terms, that not all loans are equal.
Yeah, Javi, do you have anything to add there from what you were seeing in the research? You saw two types of use cases.
So prior, when we were conducting the research, we saw two different use cases. One was the daily cash flow. So I just need some facility to buy these goods and then pay you back later within the next few days. We also saw there was demand for like stock up in bulk, like above $500, because they wanted to buy for the whole month and then pay after a month. For some reasons, we decided just to pilot, for strategic decisions, we decided to just pilot that daily cash flows facility, and then probably look at after to the bulk of buying goods, like for a month or a few months.
Okay, let's move on to the next point. Agree or disagree that for many merchants, it would make sense not to take on a credit?
I do agree. In particular, what is that credit for? For example, if you are offering me a credit to buy like $20 and I have the cash, I will always go with the cash. It will depend on the what is the loan for, the purpose of the loan. And as we saw in the pilot, 50% of the merchants among this sample still use cash.
Yeah, at the end of the day, it's your business decision whether you run your business on a prepaid basis or postpaid basis. And of course, there's always uncertainty that kicks in that makes you have to take credit when you didn't want to. But basically, what is the philosophy of your business? Maybe credit need not be part of that equation at all.
I think that's for me. Mm-hmm.
Sorry, just to add, I mean, the statement is very, very blanket, right? For many merchants, it would make sense not to take on credit. I mean, in general, you could almost argue that it always makes sense to take on loans if you're going to be able to purchase material that then you're going to sell and then pay back the loan. So why not take on a loan, right? I mean, you would have to have a strong argument not to take on a loan, right? If you have the capital to finance it yourself, but you could use it for something else, then maybe you shouldn't, you should take a loan if you can use it for something else. But unless you don't have any other opportunity to use that capital, then you can finance yourself. I mean, I struggle understanding why there's a good reason a merchant shouldn't take on a loan if somebody is willing to offer it.
Well, I mean, the interest rates on these loans is fairly high, so it's not like your business necessarily has a return that makes that a good way to run it, first. And second, I think we do need to differentiate between the growth phase and a stable business. Plenty shops in the world are run by people who have no aspiration of this getting any bigger than it already is. It does the trick. It pays for my bills. This is all I want. So when it's in that stabilization phase, it kind of makes sense for loans to be taken out of the picture. But for the growth phase, presumably you're investing in the business for growth because you think there's going to be an ROI that's going to exceed the cost of funding. So it's easier, that argument, for me, it's easier to accept as a blanket in a growth context, not so much in a stabilization context.
So
any reactions from, okay.
No, so I got one question for Javier. So in your experience, what were the kinds of interest rates that you were seeing on the ground? I mean, do you see cases where there's, merchants were discriminating and saying, I would take this loan, but not that one, because interest, they could see how that might hurt their business case?
It depends. It depends. We have seen, for example, some of the digital lenders that I don't want to mention the names. They offer like quite high interest rates, about 10%. And that 10% can get your profit that you will get out of those goods. But for example, we also saw that they use Mswari to buy goods. The only issue with Mswari, which has fairly decent interest rates, because you still can get a profit out of those goods, you are paying them for a month. So it's the term is for a month. Even if you pay back within the next 7 days, you are still paying a month out of interest.
I see.
Michelle, anything you saw about merchants and their interest in credit as they go through the different stages?
Yeah, I think I actually disagree with this statement of many merchants will actually sense not to take credit, because when you look at it, they're already accessing credit from the suppliers. It's just that they're paying it later. They're not seeing it as credit. Supplier will bring the goods in the morning and then say, I'll come back either 2 or 3 days later and access it. So it's not likely cash credit, but it's in-kind credit. So they are already taking some kind of credit. So if you're able to digitize that and show that they're able to repay, then that shows that they're able actually to take on this bigger credit. But agreeing what Javier was saying, it depends on the stabilization phase and the growth phase. For growth phase, they need a bigger amount of money, and that can only be accessed through either form of financial institution who's able to lend that amount of money.
But Michelle, you're making it sound like most merchants get terms on the products they buy from suppliers. Most of the time it's cash on delivery, isn't it?
Not from anyone. So for example, out of the research in one area, we saw that all of them, 100% of them, they receive at least from one supplier. And this supplier can be the bread. So they deliver the bread in the morning and then they go back in the evening just to pick up the cash, but not from the major FMCG goods. We saw other regions that no one gets credit because there is for example, a major wholesaler in the region who doesn't. And all retailers go to that particular wholesaler to buy the goods and he doesn't. But it depends on the goods. In particular with the bread and the milk that are on a daily basis, they get the intra-day type of credit.
Okay.
So going back to the question then, of just, is it enough to offer credit? Is it enough to help them survive with credit? How should we think about growth for the merchants?
Well,
I mean,
sorry, please.
Okay. Yeah, I see the growth beyond credit. I mean, credit is not the only thing. I see a bundle of different services that could be offered to small businesses, including training, improving or policing your business skills, but also how do you minimize the risks around the shop that sometimes are unexpected, like health issues or even school fees. We know that some merchants, they go to bankrupt right after the school fees because they don't have enough money after paying the schools to buy goods, for example. So there is a bundle, should be a bundle of different services, including insurance, training skill, or even improving the inefficiencies of the value chains from on these particular markets.
So one question I would have is why, not why, but so in order to be effective, loans, merchants need loans, but they also need other stuff. So should we expect banks to be providing the other stuff, or do we imagine some sort of a ecosystem that would be the best approach to it? I mean, would there be different players involved in providing these things, or not?
Yeah, I mean, I kind of agree with that. And in the context of growth, I think that's where digitization becomes more tractable, probably, because one main reason why small businesses don't want to grow, have no aspiration to grow, is not just because they don't have the funds to grow, but also it feels like loss of control by the business owner. I know everything in my business. I'm always there. Growth means having to trust people, not being always in control of everything. So that's where digitization comes in as a solution for the merchant, for the store owner, or the business owner in general, to feel again more in control rather than the opposite, which is how he normally feels if you just want to try to digitize my day-to-day, which I already handle quite nicely. So that's where some partner has to come in to help manage the growth, both from the control aspect of the entrepreneur, the merchant, as well as the credit that comes with that. And I can see that being a package. At some point, someone's going to figure out how to make that attractive.
So Ignacio, I mean, I wanted to ask about the ecosystem, but I think it makes more sense to, we started alluding to it in the beginning, is that what is the path to digitization going to be? Is it the banks? Maybe not. Is it going to be the suppliers? Is it going to be the merchants? I'd love to hear from everybody what you think, who will spearhead this digitization.
Yeah, it's still an open question. Part of digitization might be, if you digitize, we'll give you credit, although it doesn't seem like banks are that eager to jumpstart that. If you digitize, then you can take, you can digitize by taking digital payments, except that most stores at the base of the pyramid, customers don't want to pay digitally necessarily because they don't have any digital money. Their transactions are, their money is not digitized. That's not going to come that way. There's a question, actually, the Q&A, is it going to come from bookkeeping? I think it's hard to imagine bookkeeping providing a very tangible short-term benefit to the store, the feeling of a short-term benefit, immediate benefit for the store owner. So that is, I think, again, like credit, something that comes at the end of the digitization process as a nice surprise. Rather than what causes digitization to happen, could happen from suppliers. So what are all these angles that come together? I think it's hard to imagine one of them just doing it. I think it's more some kind of platform that brings together the information from all this partial digitized information.
Yeah, I also believe that having this complete view of the digital business is going to take a while. It's going to take even generations. So, but I strongly believe that it's going to be like the tech players, the ones who are going to push that frontier, developing technology for these small businesses with or without the bank, probably sponsored by the manufacturers, like, the big manufacturers and doing these things in other markets, like, developing and deploying this solution in other markets. So for example, and in Asia and in Latin America, there are already some solutions there that are picking up in the market. Also, merchants are more aware of the digitization need for their businesses too, in order to compete with their convenience stores, for example. But I think it's gonna take some time, and in particular in the African context.
So let me ask, bring some of the QA into this because they're relevant to the questions we're answering here. Andrea is asking of any examples where manufacturers or FMCGs are offering credit directly and bypassing suppliers.
I'm not familiar.
No.
No, we have seen some partnerships, again, like a supplier with a bank and a tech provider, but not directly the FMCG in this context.
I think in Latin America, there's been many variations of schemes that have been tried by large FMCG companies. So I wouldn't be able to point out right off the bat whether something is being operationalized now, but these are schemes that have, for many years, they have been tried.
Yeah,
but these
Yeah,
would be working through the distributors. They wouldn't be bypassing the distributors.
I think there's been different variations across the board.
Yeah, in Latin America in particular, in my experience in Mexico, yeah, I have seen the FMCG goods directly lending to the small shops because they also have direct distribution. So they go to the shop with their tracks and they know that merchant rather than through some other distributor within the value chain.
Okay, and so specifically, Nicholas from the audience is asking, going back to the bookkeeping option, do you think there's an opportunity for digital bookkeeping tools before expansion phase 2 to support the building of credit history if designed appropriately for the type of merchant, i.e. suitable for financially and digitally literate micro-entrepreneurs?
Well, as I said, I think bookkeeping by itself, I think find it hard. I think it's find it hard for the ex ante, the merchant, to think, yes, that's what I need. Maybe they're surprised, 6 months down the road, oh yeah, by doing all this bookkeeping, I got all these analysis and all this advice, and that was great. But it's hard to imagine that that's such a big foot in the door. I think the bigger opportunity is in the context of growth, as I was saying, for me to feel more in control. But then it's not just the bookkeeping, but it's the tools that allow me to know what's going on in the shop when I'm not in the shop, and not just from a bookkeeping point of view, also from from the inventory and or even cameras on the stores, just feel more in control.
One typical use case on that is the employees. So yeah, the shop has grown and now has multiple employees. So the owner has to somehow control what is happening in the shop, in particular when it comes to the level of inventory at the shop.
Okay. Rob is asking, has there been an example where merchants are saving to finance growth, and how can these saving records empower borrowing?
Yeah,
Yes, we saw in some cases, especially a different type of merchants who were taking their business seriously. Immediately they start earning some income, they're keeping aside some money in a form of financial service, a formal actually financial service provider, and storing some money for hopefully be able to actually access a bigger loan. But they were very people who are taking business as a main source of income and not just a side hustle.
Okay.
My sense, I mean, I don't know to what extent, there might be cases where people have saved for that. But I do want to point out the complication that comes from, merchants managing the finances of the shop in a mixed way with their own family or household finances, and that creates a lot more complications. So, therefore, the need to finance or to provide a range of services for the shop and for the merchant as a household as well.
Okay, we have Hamilton asking, why did a merchant sign up for SocoWatch? And what was the primary carrot that they hang in front of the merchant's face to get them to sign up? Was it strictly quick access to inventory?
Sign up for the pilot, I guess. SocoWatch supplies goods. They supply to thousands of shops. They also offer competitive prices and deliver to the shop. That's one of the reasons just to buy from SocoWatch. Then to sign up on the lending, It's a different. So first, you have to have a smartphone, and you have to be a smartphone ready to use that. And also, you have to have this appetite of credit, like that need of credit that is not for anyone.
But fundamentally, convenience, no? The proposition fundamentally, it's convenience and speed. So my understanding, correct me if I'm wrong, Javier, that basically their delta in terms of innovation is remote ordering. You don't have to go to the distributors in order to order. And so you can do it by phone when the agent comes, by SMS, and then the goods come and you pay them.
Yep. We have also seen that most suppliers are now starting offering these delivery services, whether it's through like informal, delivery guys that just could go and pick up and deliver. But we have seen that competitiveness on this market in particular, like growing.
Okay, Mohammed is asking what data points would you say are key for players to deeply understand the informal market in order to credit score merchants?
Well, for me, it seems like it would be anything that shows the regularity of the business, but also the seasonality, so that you understand the cycles they go through and you can accommodate that. That would seem the most important to me.
Yeah, it depends. Probably if we ask the banks, they will see turnover. We'll always look at like that. What is the turnover of the business? If we ask Sokowatch, they may have like the trust, and that's something not easy to digitize. Like, I know this business, I know my agent is going here, and they have such a good relationship and close relationship. So there is some kind of relationship on that to decide whether to lend or not.
At the same time, Hamilton asks this question, which is interesting. So is formalization something merchants fear? For example, for taxes, any tips on how to make it less scary?
I think this is where we've been talking about a win-win situation. What's in it for the merchant? So if I formalize and I have to pay all this amount of money in terms of taxes, what is it at the end? What's the carrot at the end? But if I'm told by formalizing and actually having all these documents, then I'm able to access credit, or I'm actually able to access this range of financial products, then they're able to do that. I think, it's just judging on what's the win-win situation for both.
Yeah, I agree with that. I think formalization, there's a cost, and that needs to be outweighed by benefits. So I think it's more about increasing the benefits of formalizing rather than reducing the costs of formalizing.
Well, I think the equation, well, first of all, this is a big issue, I think. And I think if there's more to it than the business case around it. It's the benefits and the costs. I think in some countries, people just are very wary of whether the government has access, the government or anybody else has access to these records. So in some contexts, people, even if there's a clear business case for using formal tools or for engaging with formal institutions, people might decide to not go that route if they can.
So I want to wrap up with this last question for everyone on the panel. I'm getting peppered here by the audience, so I'm sorry if we can't answer everything today, but I'll make a point of sending them to the panels to answer as appropriately. And the last question I wanted to ask is, so what have we answered about merchants and their financing needs? Where do we go from here from what we've learned? That's a tough one.
I mean, we are looking at like bigger type of financing, and instead of looking at very small purchases that can help you to balance those cash flows on a daily basis, we are now looking at what is the 90% of the shop. What is the shop buying that 90%, and why don't we go to that and then we provide credit on the 90% of the shop. to really see what is the impact of that larger financing, for example, rather than small tickets.
Any thoughts from you, Javier or Ignacio? Michelle?
To me, one thought is that it would be useful to learn more about these different stages that Javier and Michelle have explained around, where the life cycle of merchants and what is appropriate and what works in each case. I think the more we understand that, then maybe it's going to be more effective supporting finance for those institutions, for those merchants.
And for me, link it, if you don't mind, I'll link it to one of my pet themes, which is that in general, where digitization of business happens or of transactions, it's mostly because the payer wants to pay digitally. It's rarely because the receiver wants to receive digitally, because that exposes them to taxes and so on. So that is what's worked in the West, is people adamantly want to pay with credit cards, and so stores accept credit cards or debit cards. Unfortunately, in Africa and South Asia, we're digitizing payments, but not money. So customers have no particular interest in paying digitally because their accounts are empty. So if we don't get on with digitizing money, people will not insist on paying digitally at the store, which at the end of the day is the best way to digitize the stores, because people insist on paying digitally.
Okay. I want to wrap up quickly with our final poll. We have this one here. And let me share this while we get some responses from you who are in the audience on the value of today's material. And I'll also take advantage to share with you, with this webinar, we're launching the FIBR case study called the Sweet Spot, Designing Credit Solutions for Small Merchants, which you can access on the FIBR website. There's a short link there for you. And we'll be following up with the webinar recording, our recent publications on merchant research, what's up consulting, the life cycles, and the experience of small merchants, as well as the case study. So please do take a look at that. It's featuring the content from today's webinar.